Chapter 4, it's about preparing financial statements, finalizing the accounting cycle and closing process of those temporary accounts. Also understanding what a classified balance sheet looks like, which is very important subject for accountant to understand the classified balance sheet. By understanding classified balance sheet, you can understand the status of the company in regards to liquidity ratios and solvency ratios. The importance of business liquidity and concept of operating cycle, and that will be the last thing we cover. This is the accounting a sample of your exam 1. So if you want to practice your exam 1, here it is. Exam 1 will be literally the same document, different number. So here it is. Practice your exam 1. And I do show you in 4 parts how to start and finish it all the way to the end. If you do really good on this and you understood it, then exam 1, you start and it takes you about 1 hour to finish the exam 1. Okay? Okay, let's go to financial statements. In chapter 4, preparing financial statements, you have to do few steps at the end. Here says you need to create a trial balance before the adjusting entries to look at your trial balance, existing balances of every single account. And obviously also make sure that the trial balance at the bottom, the debit side and credit side of the trial balance is equal. Then you will start doing adjusting journal entries. Those adjusting journal entries normally comes from your worksheet. The worksheet is where you identify specific accounts that needs to be adjusted and how much needs to be adjusted. And also in the worksheet, you will have a preview of your income statement and balance sheet. If the worksheet is properly done and you get a thumbs up from your accounting team and management in regards to possible suggested adjusting entries, then you bring those adjusting entries and you do it literally as a form of journal entries. We call it adjusting journal entries. After adjusting journal entries are saved and posted to the general ledger, then you prepare your post adjusting journal entries. You post the adjusting journal entries to general ledger, and then you prepare your final adjusted trial balance. Using adjusted trial balance, now you can prepare your financial statements. So financial statements data comes from the adjusted trial balance. Okay, so here is the adjusting process for this business, for example. So we have a trial balance, which company name is at the top, name of the report in the middle, and a date. Then you list all your accounts, whatever is debit side on the debit side, whatever it's a normal balance of credit, you put it in the credit side. The first number starts with the dollar in the column, and the final answer is also $, double line. As you see, the account name are you cannot mix them up. It comes based on account number. So let's say cash is the most liquid, is account number, let's say 110. Accounts receivable is account number 120. Equipment is account number 170, let's say. Accounts payable is, let's say, 210. Unearned revenue, 220. So it comes one after another. So after your trial balance is ready, then technically you can take this trial balance to the worksheet, which I did show you in my 4-part accounting cycle videos, how to work with the worksheet. So you take to the worksheet, you suggest what's supposed to be adjusted, get an idea of possible income statement and balance sheet in the worksheet, discuss it with your team, in your accounting team and management. Everything says, looks like okay, there's nothing else to adjust. And based on that, thumbs up for the worksheet. You use the worksheet as a template and you start doing adjusting journal entries. So these numbers are coming from the worksheet. Whatever you suggested in the worksheet needs to be now adjusted. So here let's say you adjust the depreciation expense for $5,000. So expense will go up, normal balance debit, and accumulated depreciation will go down. I mean, go up also. So expense goes up, accumulated depreciation will go up. Accumulated depreciation dash equipment, it's a contra account to equipment. That means instead of crediting your equipment key account, don't touch it. Create a contra account to equipment, call it accumulated depreciation dash equipment. And using that contra account, you can all the time see how much has been depreciated so far. And looking at the equipment key account, you can see how much equipment historically you have purchased already. Any question on depreciation expense and accumulated depreciation? Okay, how do you decide how much is the depreciation expense? There are a few ways to use it. One of them is straight line method. Under straight line method, you have to calculate total cost of equipment, including purchase price, sales tax, delivery, and installation, to the point that it's ready for the intended use, minus residual value or salvage value. That's an estimated value. It might be zero, it might be whatever you believe it might be. Divided by estimated useful life. Again, it is estimated, whatever you believe, 3 years, 5 years, 10 years, whatever it is. And that gives you annual depreciation. So original cost minus residual value is depreciable amount. Divided by useful life gives you depreciable depreciation expense on annual basis. So here we got $5,000, and let's say we debit expense, depreciation expense, and credit accumulated depreciation. Salaries expense is for those days that your employees worked already before the end of the year, but still you didn't pay them, like for a few days. That end of the year falls at one specific day and still you didn't pay. So whatever you didn't pay yet, you need to recognize it. So salary expense is $2,000 in this case, and salaries payable will be credited. Interest expense is for those amount of interest that has been incurred during the period that you need to recognize, which is original principal times interest times time. The time depends how many months has been passed. So that's the expense will be debited to increase the expense, and the liability will be credited to increase and recognize the liability. Unearned revenue is the part that you got cash already from customers in advance, and you want to now record the completion of job and earning of the revenue. So in that case, the unearned revenue, the liability will be debited to reduce it, and revenue will be credited to increase and recognize the proper amount of revenue in that year. So after adjusting journal entries are done, you post them to the general ledger. One by one. You post this one first, and then you post the second one, and the third, and the fourth, and all of them will be posted in the ledger, and ledger now is completely up to date. Now you pick up the general ledger T accounts balances, and you create the trial balance one more time, but this time you call it adjusted trial balance. So just to cap it what we said, you start with trial balance, take the trial balance information into worksheet. You suggest what should be adjusted. You find out what is possible income statement and balance sheet outcome. If every group, your team, your accounting team says yes, thumbs up, then you go to the software and you enter your adjusting journal entries. After adjusting journal entries are done, make sure your T accounts are updated, posted to the T accounts, and you prepare adjusted trial balance. At this point, again, make sure at the bottom is you have equal balances, and everything that is a debit is on the debit side. Everything that is a credit normal balance goes on the credit side. It's very easy to in trial balance to make a mistake. Let's say this $5,000 is very easy to put it on the debit side, and you completely mess up the whole thing. Okay. Any questions so far? Okay. Now you are going to prepare financial statements. From top, which is cash, all the way to revenue, up to here. That part goes in the balance sheet. From revenue, all the way down, up to end of the expenses, goes in the income statement. Dividend goes into statement of retained earning. So let's go with income statement, which is number one. So pick up anything in the revenue and expenses, pick that area, and go to number one, which is income statement, and create your revenue, 32,800 equals to that box right there. And all the expenses equals to that area. Add them up. And then total expense minus total revenue gives you net income. I've seen students who, after this point, they add the total expense to the total revenue, and they get a crazy big number in here. No, revenue minus total expense gives you net income. Or in some cases, if expense is larger, then net loss. If it's net loss, put it in the parentheses. Here said net income, parentheses, net loss. And then here, the 2,600 should be in the parentheses. The financial statement, income statement starts with the company name at the top, name of the report in the middle, and the proper date after that. Proper date, that means for the period. That period might be a year, a quarter, a month, but here is a year. So for the year ending December 31st of 2013, that's for the whole year. Okay. Any question on reporting number one? Okay. Reporting number two is statement of retained earning. if it's a brand new company, your beginning retained earning is 0 plus net income, which comes from report number 1, add up, minus dividend, which comes from trial balance here, the dividend right there. So dividend will be calculated and accounted for in the statements of retained earning, or also they call it statements of stockholders' equity. Statements of stockholders' equity, it's a little bit wider report than this. It will be like that area because the stock issuance will be also reported next to this line, but statements of retained earning is much simpler and good enough. So that's dividend of $1,000 minus $2,600. That's ending retained earning of $1,600, double line dollar sign. This ending retained earning of $1,600 is a leftover earning that the company can decide what to do with this in future, either buy new equipments, buy new machineries, pay more dividends, something, whatever they like to do. So this is leftover saving for the company to do something in future. And so what is the payout ratio? Payout ratio is how much dividend the company is paying out to shareholders compared to total net income. So the net income is $2,600 and dividend paid is $1,000. So if you take your calculator and you say, okay, what is 1,000 odd of divided by 2,600? That is 38.5% almost. So the payout ratio is like 38.5%. That means 38.5% of income of this company is getting paid out to shareholders. Any question for income statement and statements of retained earning, please? No one? Okay. Very good. Balance sheet, the number 3. Balance sheet is a moment in time. So make sure the date that you put it in here is showing just a moment in time as of December 31st, or just say December 31st. Balance sheet comes with the asset, liabilities, and equities, which is accounting equation. Asset equals liability plus equity. So start with your asset, most liquid one at the top with a dollar sign. And then receivables and any other things like supplies, inventories. And then you get to fixed asset, which is equipment, and less accumulated depreciation for the equipment, which is a contra account. So the net equipment book value at this point is $40,000 for the end of year 1 of operation. And the total asset for the company is $60,000. And in later on today, you're going to learn that the current liability, current asset is the asset, like this two, the asset that can be converted into cash within a year or less. That's current asset. And the fixed asset is this part, which is book value of $40,000. How about liabilities? Liabilities, again, the current liabilities, which is the accounts payable, salary payable, interest payable, those things that needs to be paid within the next 12 months or less. Those are current liabilities. They go up first, obviously. And then long-term liabilities, let's say note payable or anything else, goes at the bottom. This note payable looks like it's not a current long-term liability because it is mixed up with current liabilities. So if it is a current short-term note payable, a year or less note payable, then obviously it will be a current liability. Add them up, that's your total liability on the right-hand side. And then you go to equity. Equity has a minimum of two parts, capital stock and retained earning at the minimum level. Capital stock is the stock that you issued on the very first day, and the retained earning is the number that comes from statements of retained earning right here. So that gives you total stockholders' equity of 31,600 plus the liability of 28,400 gives you total liability and equity of $60,000, dollar sign, double line, and that equals to the total asset, and balance sheet looks perfect. Any question on these three financial statements, please?
Yes, I have a question. So it looks like on the adjusted trial balance, you do not take the accumulated depreciation credit away from like the equipment, but when you actually go to the balance sheet, you do make the adjustment there. You took the 5,000 out of equipment in that balance sheet.
Let's look at it.
Right. But at the adjusted trial balance, you don't. You leave it be.
Here is the adjusted trial balance. Here is the equipment for the $5,000, which is normal balance of debit, right?
Okay, yeah.
And accumulated depreciation has a normal balance of credit, right?
Right, yeah.
So it's there.
Okay.
Right? Yeah, so anything is debit should be on the debit side. Anything that is normal balance of credit then should be on the credit side. And your debit and credits are equal, which is perfectly fine. Now, when it comes to the balance sheet, then you have to demonstrate that, hey, yes, I have $45,000 of equipment, but I have a contra account, which is accumulated depreciation. And since it's a contra account, so you say less. So 45 less contra account of accumulated depreciation of 5,000. So the net book value of the equipment is $40,000. Imagine at this time, we decide to sell the equipment for $42,000. If we sell the equipment for 42, then because the book value is 40, so we will have $2,000 gain on sale of equipment. If we sell it for $37,000, because the book value is 40, then we will have a loss of $3,000 on sale of equipment.
I see. All right. Thank you.
Yeah. The trial balance, remember this, listen carefully. The trial balance is the only report that has a debit side and a credit side. One more time, trial balance is the only report that has a debit side and has a credit side. Anything else like this stuff in here, income statement or retained earning or balance sheet, there is no debit or credit conversation here. It's about just being neat and clean and easy to understand. So if you have revenue, if you have just one type of revenue, put it in right-hand side, case closed. Because you have so many expenses, then go one step to the left column, put all your expenses in here, add them up, and transfer the total into the right-hand side. So the right-hand side is not like 405 freeway. It's very easy to understand. The right-hand side says the total revenue is this, your total expense is this, therefore your net income is this. So there is no debit side, credit side. This is just being organized. So you go to the left, add them up, put the total to the right side to be organized. Again, same thing here. You go to the left, you put your numbers there, 45 minus 5, and go to the right and put your net book value of your equipment on the right-hand side. Now on the right-hand side, it's very easy. 15,500 plus 4,500 plus 40,000, it's 60,000. So it's not a 405 traffic, hard to understand, confusing balance sheet. It's very clean, very organized, simple to understand. But when you go to trial balance, Yes, you have debit side and you have credit side. Questions? Okay. And I did show you how to work with the worksheet, and please watch my video so you start learning how to work with a worksheet in accounting. This is how worksheet looks like in this example. Again, as you see, there is a trial balance. Both sides are equal. Then you suggest some adjustments. Both sides are equal at the end again. So those adjustments are just suggested. And then you construct your adjusted trial balance based on those adjustments. Let's say here is 30,000 credit, you do 1,800 debit, then the leftover is 1,200 credit, right? So adjusted trial balance is constructed, both sides are equal, perfect. Using adjusted trial balance, you pick up the portion that is revenue and expense, put it on the income statement column, and as you see, now you have two balances that they are not equal because you add up all your revenues and you add up all your expenses, but they are not equal, which is very good, no problem. You go to the under expense, one more time, you go under expense and you say equals to, click to this box, 32.8, minus, click the other box for total expense, enter. And then $2,600 will pop up in here as a positive number. And because it's a positive number, obviously you leave it like that because it's a net income. But here you write net income, parentheses, net loss. So in case it's in the parentheses, that means it's loss. But in this case, it's a plus because revenue is bigger than expense. Now you add them up. It's 32.8. You add 32.8 plus 0 in here. It's 32.8. Both sides are equal, double line dollar sign. Then you go to the balance sheet, statements of retained earning. In this case, in my video, I skipped this part because it's not that much a big deal. But again, you want to put it here. The dividend comes in the statements of retained earning. Okay. Now, that $1,000, you see, that's why I didn't put it in my video because it's getting a little bit confusing for students. So the $1,000 will stay there and comes at the bottom, that $1,000, and then you transfer the net income in here to the credit side of this column, which is nothing in here, just transfer the net income here. So just like statements of retained earning, you say, okay, I have 2,600 net income plus minus $1,000 of dividend. It gives us $1,600 of end retained earning, and then you add them up. But all I suggest, just skip that statements of retained earning in this area. That will be much easier. And you just start the balance sheet and pick up from adjusted trial balance, whatever you have, put it in the balance sheet. And you see that dividend that is in here in the statements of retained earning. If you just skip that statements of retained earning, put that dividend right here on the debit side, right there. Okay. I know the dividend is not in the balance sheet, but this is just a worksheet, okay? This is not an official report of anything. So put that dividend just in here to make everything accounted for, okay? And then add up both sides. It will not be equal. Then you just transfer your net income under the balance. Here, if you watch my video, you will see what I mean. And then add them up. And if you add your balance sheet balance, the net income goes under the smaller number. And because net income goes under the smaller number, you add them up and both sides will end up to be equal, and that means your balance sheet is also balanced. If the net income doesn't make your balance sheet balanced, that means you made a mistake somewhere. So please watch the video to see a little bit simple method of worksheet without having statements of retained earning to add confusion. Okay, if there is any question at any time, please ask me, okay? Here's another example of, again, worksheet in here, which you can study that. But the best worksheet that you want to watch and learn, watch that video, and I explained the worksheet properly. Very simple method. So what is accounting cycle? Accounting cycle is the procedures needed to process transactions through an accounting system, including journalization, posting, preparing, adjusting trial balance, and financial statements. Okay. At the end, after financial statements are done, you need to close. And what do you close? You close temporary accounts. That means you make them zero. Temporary accounts are something that belongs to that specific time period. Let's say revenue, expense, dividend. Those three things definitely belongs to that specific year. So you need to make them zero, because the next year in January 1st, 8 o'clock in the morning, when you open the business, it's a new cycle, and you want to make sure that your revenue, expense, and dividend shows zero balances, so you can start fresh. So how do you reset those temporary accounts, so-called close it? There are a few ways to do it. One way is here, let's look at it. So step one, it says, close the revenue account to a unique account called income summary. So this is a traditional way of closing. You close the revenue in a temporary account, which you call it income summary. Okay, and most books are showing this way. So you close revenue to income summary, and then you close expenses to the income summary. So after revenue is in the income summary and expenses are closed into income summary, then the income summary is where you summarize your income. So you summarize your income, you say, okay, revenue minus expenses equals whatever it is. And then you transfer and close income summary balance into the retained earning, which is step number 3. Okay. In some books, they might show you another way to close it, like close the revenue into retained earning, close the expense into retained earning. And by doing that way, you are skipping the income summary idea. But having an income summary, I believe it's a traditional good way to do it, because you summarize your income over there and then you transfer the cute number of whatever your income summary is into the retained earning just once. Anyway, after the income summary is closed into retained earning, the last thing you do is just you close the dividend directly into retained earning. Okay, so 4 steps. So here are the 4 steps. Let's say you have 32,800 revenue on the credit side. So you debit your revenue to close it, to make it zero. And you credit the temporary income summary that you opened for 5 minutes. There you go. Then because expense has a normal debit balance, so you credit every single expense you have one by one after another. credit, 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 credit. You make all your expenses closed, add them up, and you left a blank line in here. So this line equals to sum of all these credits, enter. And this 30,200 will pop up in this cell. And that's how the closing entry looks like for expenses. Now, the income summary T account looks like 32,800 on the credit side, 30,200 on the debit side. So the difference is 2,600 on the credit side. Now it's time to close. So you close your income summary. That means you debit it to make it 0 and put the cute number of income summary into retained earnings. The last thing you close is closing the dividend, which is do a credit on that to close it. Normal balance is debit, so you do opposite, which is credit. You close dividend by doing credit and debit retained earning. So now retained earning at the end will have a balance of $1,600. In an accounting software, you don't do this closing entry. Let's say in QuickBooks. In QuickBooks, you don't close. Don't worry about that part, because anytime you ask for a report, the moment you enter the date, the QuickBooks itself, it will look at the date and it will prepare the reporting for you without doing actual closing. However, you might close the access to the previous months and years. Why you do that? Because you don't want any of your bookkeeping personnel to go by accident to the last year and mess up anything in the last year. You close the access of your employees to last year, but you don't technically close like this because it's a sophisticated software. And the moment you say, I want my financial reporting up to this date, the QuickBooks will automatically calculate what the revenue and the expenses are as of that date, and it will give you the reporting. So you don't need to literally do this type of closing in a QuickBooks software. Okay, let's see, there is a question, I believe. It says, so far for the worksheet to prepare financial statements, it does not need to have for the year ending. It is okay to just have as of. Yeah, doesn't matter that much. Just put a date, because again, worksheet is honestly, it's your scratch paper. Nobody cares about your worksheet, and nobody is looking at your worksheet. It's just between you and your accounting team. As long as you just put a date, yes, that's good enough. Okay. Any other questions in regards to how to close temporary accounts? Okay, this is where I see some of you in the exam part, because you practiced whatever is in the beginning, you know, excited, and you practice it and you know it. By the time it gets to the point that you need to do closing entry, you kind of looked at it maybe once or twice, and you don't know exactly what you're doing. So this is where you start messing up the Excel document for accounting cycle and so-called your future exam one. You know up to adjusting entries, how to do it, but when it comes to the closing, you forgot because you didn't spend that much quality time on that. So make sure, don't give up your excitement and say, oh, I know enough. Who cares about closing? Because this is part of your exam anyway, and you have to do the closing entry. So if you don't do this properly, from this point on, like almost 30% of students start getting mistakes and messing up things at that point. Okay. So here is the picture of the T accounts again. So you close the revenue by doing a debit into income summary, and then you credit all your expenses, add them up, and do a debit in the income summary. And the last thing you close is the dividend into the income summary. You close your revenue into income summary, dividend, one more time. Close the revenue in the income summary, expenses into income summary, and you get a balance. You get a balance of $2,600 on the credit side. Then in order to get rid of that balance, you see, that's why the way it shows, I don't like it, because it doesn't show the balance and then closing part of it. So anyway, this credit side, as you see, it's bigger number than debit side. So you have a balance on the credit side, which is $2,600. In order to get rid of that and make it zero, you take it from the debit side, you debit income summary, and you put it in the credit side of retained earning. Now your retained earning has $2,600 balance plus the zero retained earning from the beginning, because this is a brand new business. Then the last thing you do is just close your dividend into the retained earning, which is credit dividend and debit retained earning. And 26 minus 1,000 is 1,600, and retained earning double line $. Any question maybe on the T accounts? Okay. Then you create your last part of trial balance, which we call it post-closing trial balance. So after posting all these journal entries, all this into the T accounts in the general ledger, there are some accounts that are still left, and they will stay as it is by end of the year. Those are post-closing trial balance, which reveals the balance of accounts after the closing process and consists of balance sheet accounts only, which is assets, liabilities, and equities. Okay, so here we go. Assets, liabilities, and equity. In the equity, now you see the retained earning has a balance of $1,600. Bottom line, both sides of debit and credit sides of the trial balance, post-closing trial balance is equal. And you pick up this post-closing trial balance and you go to the next year and start your operation again. Okay. Reversing entries, it's optional for you to learn. You're not going to get tested on this, but it's optional accounting procedures which may prove useful in simplifying record keeping, a journal entry to undo and adjusting entries. One of them is, let's say, salaries. Let's say in previous year, you record salaries payable of $2,000 in order to recognize proper amount of salaries expense in year 2013, which is good. And then you prepare your financial statements. And you have a respect for the fact that whatever happens in 2013 has to be recognized in 2013. 13. However, it might be a little bit confusing when you are doing payroll because already you recognize some salaries expense here. So in order to not create any confusion in the payroll department, as of January 1st, you see in here, if you don't do any reversing entries, in the January 1st, January 15, when you do the payroll processing, then you have to record salaries expense of just $3,000, even though you are going to pay $5,000, right? So the payroll department has to be very careful to record the proper amount of salaries expense, which will be very confusing at that time, right? And close the liability that you already recognized, which is again another confusing part for payroll department. So in order to not confuse your payroll department, this is not a good way to do it. So you record the expense, which is okay, fine, but as soon as the financial statements are ready, as of January 1st, you do a reversing entry. So on January 1st, when on the very first day that you start the new year, you reverse whatever you did in here, okay? You reverse it. The reason is no problem to reverse it anymore because your financial statements are prepared already, right? So you reverse it and you reduce your salary payable momentarily by 2,000, which you recognized in here. You reduce it and you put a negative number deficit on the salaries expense. Remember, salaries expense is already zero at this point, right? Because we made it zero. We closed all those temporary accounts. We closed revenues, we closed expenses, we closed dividend. So if you credit salary expense at this point, it will be a deficit on the T account of salaries expense because you are crediting a zero balance salary expense. That means you put a deficit on that T account, which is fine because 2 weeks later, on January 15, your payroll department properly, as always, will process the payroll, will recognize proper amount of salaries expense of 5,000, which they do every month or whatever amount it is, and then they pay the cash, whatever they pay every time. So here they pay the cash, the salary expense goes up by 5,000. However, because the salary expense here is already having deficit of 2,000, so right on January 15, if you look at your salary expense T account, it shows $3,000 of salaries expense, which is exactly what you are doing in a regular term here. But by doing reversing entries, just one reversing entries will save so much confusion and from probable mistakes in the accounting department and payroll department. Any question? Okay. Here is the difference. As you see, with reversing entries, we reduce the confusion and the possibility of making mistake. So January 1st, we do this journal entry, and then January 15, the payroll department will do the normal job they always do without any possibility of making a mistake. Any question? Okay. Let's go to classified balance sheet. As I said, we have asset at the top equals to liability plus equity. But what type of assets do we have? We have 5 types of assets. Current assets are assets that can be converted to cash in 1 year or less, or in a better term, 1 year or operating cycle, whichever is longer. What is operating cycle? Operating cycle is a cycle that the company pays for buying inventories, making the product, finish the product, deliver the product, and collect cash from customers. For most businesses, that's less than a year. But for some businesses, it might be longer. Let's say Boeing might have 3.5 years operating cycle, because by the time they get an order, they buy inventory, they make an airplane, they test the airplane, they deliver the airplane, and they collect cash on that airplane. It takes 3.5 years. So the operating cycle for Boeing is not 1 year or less, it's longer than a year. So that's why we call it current asset. Is an asset that can be converted to cash, liquidated in 1 year or operating cycle, whichever is longer. Then after current asset, we have long-term investment. Category number 2, right after current asset, we have long-term investment. Those are investments made for long-term holding purposes, including land for speculation, securities of other companies, stocks, bonds, lending money to other companies, anything that you invest your money into that for long-term investment purposes, collecting dividend or interest or whatever, that is long-term investment. That goes in category number 2. Right after that, it's category number 3, which starts with property, plant, and equipment. In this case, those are things, assets, fixed asset that you are using for your daily business production process, like land that your employee use for parking, buildings, equipment, machineries, trucks, automobiles, all those type of things that you use in your business. After those are showing in your balance sheet, the next category, it's intangible assets. Those are assets that they lack physical existence and include items like purchased patents and copyrights, trademark, goodwill. What else? Anyway, things that are franchise right. Franchise right, like you want to open a McDonald's. You pay $300,000 to McDonald's Corporation to get a franchise right for 20 years. So that's a franchise right. It's an intangible asset. Other assets are assets that you cannot categorize in any of those 4 categories above. So you put it in the other assets if something exists like that. Let's say, for example, I can say employee advance. Employee advance is a type of money that your employee get in advance for an emergency situation, and they're gonna pay, get that deducted later on from their paycheck. So that's other assets. Okay, any question on assets in the classified balance sheet? So when you prepare a balance sheet, it should be classified.
How is land not a long-term investment? Or like, how do you determine whether it's in the long-term investment or the property, plant, and equipment categories? Very easy.
What are you doing with that land? Are you using as a parking lot, or you bought that land somewhere in San Bernardino County and you just left it there So maybe you decide to sell it a few years later to make a profit out of that. Which one it is? If it is employee parking, then it's in property, plant, and equipment. If it is bought for investment purposes, you just leave it there, and a few years later, you're going to sell it and make some profit on that. That's a long-term investment. So you have to specify what type of land you are talking about. If it is investment, you put it there. If it is daily use for your daily operation, then goes in the PP&E. Cool. Okay. We have two types of liabilities. We have current liabilities and we have long-term liabilities. Current liabilities are liabilities that needs to be paid within a year or operating cycle, whichever is longer. However, we have long-term liabilities that is normally liabilities that is longer than a year. Those are long-term liabilities. So in general, 1 year or less is current liabilities, and liabilities that are 3 years later maturity or 10 years later, those are long-term liabilities, like mortgage payable. If you have any note payable that needs to be paid within, a portion of it needs to be paid within the next year, then you show in the current liability and you call it note payable, current portion of note payable, and you show in the current liability in your balance sheet. Okay, so equity, at the minimum, you have capital stock. Those are the stock that you issue to raise capital by form of equity financing. And retained earnings are the excess of corporation income over its dividend that has not been paid out, and you want to keep it. Maybe in future you want to buy, let's say, equipment or paying more dividend or whatever you want to do in future. And here is a balance sheet classified, as you see, current assets, add them up, very important number, because you're going to use this current asset for your liquidity ratio calculation in your group PowerPoint project. So if this is your company that you are doing liquidity ratios evaluation, current asset is going to be used for liquidity ratio calculation. And you have long-term investment, like whatever it might be. You have PP&E, property, plant, and equipment, $125,000. And you have intangible, let's say goodwill. And then you have total other assets, receivable from employees, or we call it employee advance, or receivable from employees, you put it there. And that will be your total asset of $910,000, double line $sign. In regards to current liabilities, again, anything that needs to be paid within a year or less, you add them in the column, put it the total on the right-hand side. And then total long-term liabilities, and then add them up. Total liabilities will be the current liability plus long-term liability. And then in the equity section, you have capital stock and retained earning. Total equity is 1,460 plus total liability of 450. That will be 910,000. Total liability and equity $sign double line. Any question on the classified balance sheet, please? So very important subject for you to understand the classified balance sheet, because when you do the group project PowerPoint presentation, anything in regards to liquidity ratio or solvency ratio, you are looking at these details. Like you want to know what is the current ratio current ratio is current asset divided by current liability. Current ratio is current asset divided by current liability. So here is the current asset of 450,000 divided by current liability of 150,000. So current ratio is current asset divided by current liability. So here, if I calculate that, 450 divided by 150, and that will be 3 to 1. So that will be 3. That means for every $1 of current liability, we have 3 times more current asset available, which looks awesome. But how good? I don't know. I have to compare to something else. That something else can be the same company previous year, can be another company to another company, or can be one company compared to industry average. And if you want to do like long-term solvency ratio analysis, then you need to know, let's say, total asset, here, total asset, compared to, let's say, total liability, or total liability compared to total equity. Those are ratios that you can compare and then see how much total asset you have for every $1 of current liability, or how much current liability, how much total liability you have for every $1 of total equity, which those will be in the chapter, I believe 15 and 16, and also at the end of each chapter. So you, slowly at the end of each chapter, you start learning those ratios, and the complete type of ratios, again, will be visited in chapter 15 and 16. But it's better for you to learn on a chapter by chapter basis. And there are also notes to financial statements. Those are following full disclosure principle, which says all relevant facts that would influence investors and creditors' judgment about the companies are disclosed in the financial statements or related notes. And that's where the full disclosure principle comes to life in the notes section of annual report financial statements. Annual report, they call it also K10. K10, that means annual report. K-10. And to find the annual reports, K10 for the publicly traded companies, I have a video that will show you how to have access to that, or you go to Yahoo Finance and you will see the financial statements in the Yahoo Finance. So here is the Yahoo Finance, for example, Yahoo Finance. And let's say you go to Yahoo Finance, that's the easy, fast way. Here is Walmart. Let's say you want to look, and no. Walmart, that one. And then you go to financials. And the first thing it shows is the income statement, which this is the latest one. So you have to use this year, latest one as of January 31st of 2022. You cannot use the data from previous years for your group financial presentation. And if you need to see the balance sheet, click on the balance sheet. And again, you need to use the latest one. And here is the total asset, but you are not happy with that because you want to see the details. So you click on that total asset, and all of a sudden here you see the current asset and you see non-current asset. So the current asset is an important number for you for using in liquidity ratio. And then you go to liability, which is you're not happy with that. So you click on the arrow next to it, and then you see current liabilities right there. So if you want to do your liquidity ratio, current asset, current ratio, you say, okay, current ratio equals to current asset divided by current liability, and then you get the results. So in this case, I see the current asset is less than the current liability. That means Walmart has a little bit of liquidity issue. It doesn't have that much enough liquidity to pay the current assets. So it's a little bit not good. And when you use these numbers in your calculation, that's fine, but make sure you put this sentence on the corner of your PowerPoint slide all the time. That shows all numbers are in thousands. That means whatever you see in here, there are 3 more zeros next to it. Questions?
Hi, Professor. This is Kirsten.
Okay.
Can you hear me okay?
Yes.
Okay, so I was, our group's kind of started working on our project a little bit, and we have narrowed down what we're doing. And I went ahead and looked at their balance, the most current balance sheets today. And I just wanted to ask you quickly about intangible assets as listed on a balance sheet. And because it appears that there are intangible assets listed on both companies that we're looking at in both current and in current assets, and also like the long-term assets. I'm just, I guess I was kind of confused why intangible assets were listed as assets on a balance sheet.
Intangible asset is part of asset in the balance sheet. We just learned that.
I guess I just got confused because I like putting a valuation on a brand I was just really confused by it when I was researching.
Yeah, let me show you the classified balance sheet again. It's here, you see. Those are current assets, which you use for liquidity. And then for solvency, you're gonna use total asset. So there are 2 numbers here that it's very important for you. Current asset for liquidity calculation and total asset for solvency calculation. You see, from current asset all the way to the bottom, I don't care what it is inside. So I start, the numbers that I need is this current asset and total asset. Now in between, what it is inside for my ratio analysis doesn't matter. I can have different assets. I can have long-term investment. I can have PP&E. I can have some intangibles. Intangibles are goodwill, patent, trademark, copyright, franchise right, anything that physically I cannot touch them, but it's a very good form of asset, then I will put it in intangibles. Like what example did you refer to?
So that you're covering it in terms of goodwill. What I want to follow up for you just on one thing, which is interesting to me, that we have the same industry as you instructed, but I actually picked up even a third one because I want their balance sheets are so different in what they are claiming as intangible assets. One of the companies doesn't list all their intangible assets, whereas another one lists it really detailed. And so each one of these companies, even though they're the same industry, obviously they have different valuations because they're different companies, but they're also identifying their intangible assets, totally differently. So it's just really interesting. It's good stuff.
Are you telling me that if they don't have intangible asset, let's say this company has just goodwill, has nothing else to show you? Make sense? But sometimes besides goodwill, there are many other things in here. So it might be goodwill, it might be franchise right, it might be patent and trademark and copyright. If it is, there is 2 ways to do it. Either you post them, all of them in here, okay, one by one, which it's easy to see, or you call it here intangible asset, and show $275,000 and you don't give us any description of it. And then if you go to notes of financial statements, okay, if you go to notes of financial statements, you go down all the way. At one point, you will see that the intangible asset that given to you, like $275,000, it's all detailed information in that notes. Make sense? So you have two options. Either you put everything in here visible for everyone in the balance sheet, or just put the cute number here, 275, and call it intangible asset. And if people really want to know what type of intangible asset you have, then they go into notes of the financial statements, go all the way down, they find it somewhere, the full details of it. Make sense? So you have two companies that you are comparing to, right? One of them is showing the details, one of them is not showing the details.
Yeah, that makes a lot of sense. When I go, I'll definitely go look for the notes section.
Yeah, and these 275, whatever it is, either the details are here or details are not here. It has nothing to do with your project. Because in your project, you are looking at two things and two things only. You are looking at the current asset, this part, and what it is in here. So the 450 and whatever it's in here, those are the numbers are very important. And you are looking at total asset. So in between here, I don't care. If it's goodwill, I don't care. If it's patent, I don't care. If it is PP&D, not that much care. So the most for your project, for liquidity ratio, this is the area you want to see. And for solvency area, total asset, that's what you want to see. Total liability, that's what you want to see. And total equity, that's what you want to see. Okay.
Yeah, that's awesome. Thank you. That's very helpful.
Sure. That's why when I went to Walmart, I said, the total asset is not helping you. You have to click that arrow and you have to find out what is current asset. Again, in liability, total liability is not going to help you. You have to click and find out what is current liability. So you can use those numbers to calculate your ratios. And here in the equity section, you see total here, click here, stockholders equity. You want to know how much is that? 83. Let's say. So, okay, this is my equity. Okay, let's go to see if I have anything else to call. Working capital. So,
I'm sorry, before we move on, on Yahoo Finance, I don't see the statement of retained earnings. I mean, the net income's on the income statement, but do they give you dividends somewhere or?
Yeah, statements of retained earning, again, for me and you, that we are going to calculate liquidity and solvency ratios and the profitability ratios. For me, you, and the other analyst in the market, all they want to see is just income statement and balance sheet and possibly cash flow. Okay. Those are three things that we are looking at. Yes, you like to see the retained earnings statement, or so-called also you like to see the stockholders equity statement, total stockholders equity statement. Yes, go to the financial statements notes and you will see it somewhere in that area. But for us as investors or analysts, this is the three things we are looking at. So if you follow my video that takes you to SEC website, and from SEC website, you can go to annual report of publicly traded companies. Over there, you can find in the financial statement section somewhere that shows stockholders equity. in details. But for us at this moment, we don't care. All we care is just income statement, balance sheet, and in some cases, cash flow, which we don't go over there for now.
Thank you.
Sure. Okay, so for liquidity, again, this is ability of firm to meet the near-term obligation as they come due. So that's what we like to look at it. There are a few ratios. I just talked about current ratio with you. Current ratio is current asset divided by current liability, one of very good type of liquidity ratios, which I suggest to use in your PowerPoint presentation. And that shows for every $1 of current liability, how much current asset we have. And the answer for this company, let's say, is 4-to-1. 4-to-1, that means for every $1 of current liability, they have 4 times more current asset available. And there you go. So it's good, but how good it is, you have to compare to something else, another company, let's say, in your presentation. Working capital is the difference between current asset and current liability. Anything that current asset is more than current liability, that's the working capital for the company. Working capital is a dollar amount that you need on the very first day even in your business to run your business, right? You cannot say, oh, I'm going to start a business, but I don't have any money. Can you? No. When you start your business on day one, yes, I know you have no liability, but you need some money to start your business on the very first day. Okay, so that's the working capital that helps you to run your business until you get some revenues coming in. Quick ratio is a little bit better than current ratio. It's more picky. Why is more picky? Because it takes only cash, the short-term investment, which is like very liquid, and like 3 months or less type of investment, any investment that is not long-term, a year or less, let's say even, but not long-term. And then accounts receivable. Those are 3 things that they are very, very liquid, like no supplies, no inventories, no prepaid rent, no prepaid expense, none of those, just very actual liquid items, which are those 3 things. Divide by current liability, it gives you a little bit better understanding of really how much do you have for every $1 of current liability. Assuming doing that, all of a sudden ends up to be a quick ratio of 1.5-to-1 instead of 4.1. 4-to-1, you end up to be 1.5-to-1. Again, 1.5, it shows very realistic term in regards to your liquidity. And this current ratio is also a very good ratio to be more picky and more realistic. Any question on liquidity ratio, which you're going to have this conversation in your first slide of the PowerPoint, not first slide, but first main slide, which is liquidity slide. Okay. I think that is it. Yeah. So for next time, 2 days from now, we will cover chapter 5, which is very interesting chapter. At this point, starting chapter 5, we assume that you are in very good standing in regards to your understanding of accounting concepts, normal balances, revenues, expenses, financial statements, balance sheet, classified balance sheet. Technically, you are in a very good shape even to get employed. So if you very well cover chapter 1 through 4, you know the basics of the accounting. Very important. Make sure that you go over those 4 video cycles. You practice the Excel document that I am showing in the video myself, and get ready for your exam 1. And starting chapter 5, we assume you know whatever we covered in these 4 chapters, because we are building on that.